Hello and welcome back to our lecture for Chapter 4, Internal Controls and Cash. We are actually going to start on learning Objective 3. This is on your test and on your homework. So your next exam, you will see this learning objective, so pay close attention because the bank reconciliation is heavily tested. So we are going to start with what we need in order to perform this bank reconciliation. So your signature card, basically, it helps you protect against forgery. This is the card in which you actually go to the bank and sign when you set up an account. And by doing so, then they compare that signature to that in which your checks are signed. Your deposit ticket is your proof. So where you go in and the bank has you write down the check number and the amount of the check, and then they go ahead and that's the initial slip that you give with the checks or the cash that you're depositing. That's your proof of the deposit. A check, which I'm sure you're all familiar with, it's the maker who makes the check, payee, who you are paying, and the bank. Now the bank statement is, let's go back here a second. So then you have the bank statement, which we'll get to in the bank reconciliation. Let's look at the check really quickly. So now you'll see this check, and then here you have the remittance advice. Recall earlier I told you about a lockbox system. Right, and remember that was where items were sent directly to a box in which the bank monitored, and then they took the check piece and they deposited, and then this remittance advice piece they sent to you electronically. So here we have the payee is California Office Products, the maker is Mid-Atlantic, the amount is in dollars and spelled out, and then the bank itself. And then here you see the actual check number, and you see that's the bottom there, and I'm sure we're familiar with the routing and the account number. Routing being the 7 digits and the account number following after that. So this is an example of a check. Make sure you know the pieces of the check. So here's your maker, there's your payee, then we have our bank, and now we're going to our bank statement. And so this you usually get, and it kind of tells you all your cash activity, the ins and outs of your cash activity. This is our balance per bank. So here you see our bank statement, and here you're going to see that here's our ending balance, and here it gives us all of our deposits and all of our charges and our checks and then other deductions. Now recall in our cash account, in our T account, cash has a beginning balance of as a debit. We add to that cash receipts and we subtract cash payments to get to our ending balance. But now you'll see debits and credits opposite for a bank, because remember, for a bank, the money that you give them is a credit. They owe you that, right? So, and then the money that they give you is a debit. Loans are debits for banks. So don't get confused with the debits and credits from the bank statement as opposed to that of our accounting. They're completely the opposite. So a bank reconciliation, here we're taking our bank balance, which if we go back, we'll see here is the $5,900, right? So we're taking that balance and then we are comparing it to what we have on our books. So what you're going to need, right? So first and foremost, you need your bank statement. Secondly, you need your general ledger, usually the transaction detail report that tells you the ending balance in cash for your cash account, and then it tells you all the debits and credits. And the differences are usually timing differences. So we're going to have the bank side and the book side. So you should have this in Excel, and you should have this in Excel in our format and basically we'll have on the bank, you have deposits in transit, which basically represents what you actually have on your books, but is not yet on the bank side. Any outstanding checks and any errors that the bank has made. Do not think that banks do not make errors. On our book side, you have if the bank collected some money or paid some money and then you don't know about it, EFTs, electronic funds transfer, maybe your customer automatically transferred the balance into your bank and you weren't aware of it until you actually print your daily activity report or get your bank statement. Service charges are usually deducted. Interest revenue is revenue, so you made money, so that's usually added. NSF, non-sufficient funds. Checks, those are charges, and not only do you have to put the charge in, but you also have to take the money out that you thought was deposited. And then you may have cost of printed checks, and then if you make a mistake or you transpose a number, that would be there also. So let's go through this bank reconciliation for Mid-Atlantic Bank. So we saw our bank statement had $5,900, and now we know that our book balance is $3,340, and here's a bunch of additional information. So we have deposits in transit of $1,600, and then we have that the bank deducted $100 for a check written by another company. So we have to add, it tells us right here what we have to do, add $100 to our bank balance because they deducted it, but it wasn't related to us. Outstanding checks of $1,340. Then we have an EFT for some dividend revenue that we earned, keyword there, earned. So we're going to record $900. Then bank collected from one of our accounts receivable $2,100. Interest revenue that we earned is now $30, so we're going to add that back. We have a book error where I recorded this particular check for $510, but I actually should have recorded $150. These are transpositions and very typical, so you want to be careful with that. So we have to take the difference of 510 minus the 150 to get that 360 that we're adding. Then we have a service charge of $20. Then we have an NSF check from a customer, $50 that we have to subtract from our book balance. And notice, this would not be stated in this fashion as you work on your examples. This is just our illustration. So you'd have to know that an NSF check from a customer you have to subtract from the book balance. And then you have an EFT for insurance expense of $400. So here what we have is our bank reconciliation. So here we start with the $5,900 from our bank statement. We're going to add our deposits in transit. So now if I may, we had $1,600 of that. We have a correction of a bank error of $100. And then we have our outstanding checks that we are subtracting. And notice the less here and the subtraction here. So we get our adjusted book balance of $62.60. Now we have our cash balance per the books. So we're going to add the receipt of dividends, and we're going to add the bank collection of our accounts receivable, and we're going to add interest revenue, and then we have to add back because we recorded it as, so we have to add back our check because we did record it, right? So that was our 150, right? So we recorded the check number of 510, but I should have been 150. So since I did 510 and it should be 150, I have to add back the 360. Then I have my service charge of $20 and my NSF and my insurance payment. Notice anything that I'm subtracting, I have as a negative. And these two balances equal. The $62.60 on the adjusted book balance and the adjusted bank balance, they equal. If they do not, you know you did something not right. So let's go through now each piece of the and notice we are on the balance per books, right? Because this is what we have to record. We are not the bank, so we cannot record any transactions on the bank side. So right now what we have to do is make sure we're recording all of these transactions. So for the $900 of dividends that we received, cash, always remember what you're doing to cash. Remember our T account format, cash is debited to increase it. Oops. Let's go the other way. Sorry about that. Cash, and then we have dividend revenue for $900. Notice the indent on our credit side and the little description, receipt of our dividend earned. Now to show our collection of accounts receivable is, in this case, if we are collecting money on accounts receivable, we are adding to cash as well. So we have our $2,100, and this time we are reducing our accounts receivable balance. So here we're debiting cash and crediting accounts receivable. Now for our interest revenue, we are receiving $30 of cash for that. So we're increasing cash, we're debiting, and we're increasing our revenue account, which also increases on the credit side. So if you recall, cash has a debit increase and revenue has a credit increase. Now we have this correction of our error. So we're going to add 360 because in this particular instance, we said that we wrote a check, right, for 510. So when we initially wrote it, right, so this is probably, so we debited accounts. So in this case, we are doing the opposite of what we did, right? So here we recorded check number for 510, and the amount we should have recorded is 150. So what we have to do is, what we did is we did debit, we had credited cash, and we debited accounts payable to pay it off for 510, and we need to reverse that because we should have been only 150. So we debit the cash and we credit AP to correct that error. The errors are sometimes tricky, so I would always like to write what we did and how we're going to fix it, because I know that this balance is 510, but it should be 150. It also may be easier to reverse this entry, meaning do the opposite and record it properly, and you'll get the net effect. Meaning that if you did that, right, let's just assume our cash balance, right? So we wrote it for 510, and now if I write it for 360, I get the 150 as my debit, so I still come out with the same amount. So either way, if you book the 360 or if you reverse the entry and book it properly. Now let's do what we subtract. So in our service charge, we might do, this might also be service charge expense. That could also be, as long as it's an expense account, and we remember that expense accounts have a debit balance, and then cash gets credited. Now for our NSF, that's also costing us money, and usually an NSF is from your customer. So we have to reduce the cash and we have to charge that to the customer's account that caused us that, because we're going to pass that expense through to the customer. And then lastly, we're going to record our insurance expense for $400 and our cash for $400. So these are all the journal entries that you have to do from the book side to make sure that everything is correct. So this is a great summary that you want to make sure you have in Excel, in your Excel template. And you should, because you should see that from our previous example. So you want to always add deposits in transit, you subtract outstanding checks, and then your bank error, that can be an add or subtract. Now, in your book balance, you always add collections and revenue items and receipts, but you subtract the service charges, NSF checks, and we'll learn more about NSF checks when we talk about accounts receivable and our electronic funds transfer payments. Now again, corrections, that's an add or a subtract. So let's go through this particular example, and so here, if the bank statement balance is $4,500, and it shows a service charge of $15, interest earned of $5, and an NSF check for $300. Deposits in transit total $1,200. Outstanding checks are $575. The bookkeeper recorded as $152 a check for $125 in payment of an accounts payable, so that created a book error. So here we're looking for the adjusted bank balance. And if you go back to our previous slide, we see that we add, so the bank balance here, we're going to add deposits in transit and outstanding checks and a bank error. So in this case, we're taking our bank balance statement here and we're adding to it our deposits in transit of $1,200 and our outstanding checks of $575. And you're going to see that we're using in the book balance is our error, because this created a book error of $27. So that's why you don't add it here. And so our next problem, it tells us what is the book balance of cash before the reconciliation. And so basically the adjusted book balances should be the same, but it is asking what is the book balance of cash before the reconciliation. So in that case, what you want to do is take the book balance. So we have our 5125 plus our 15 plus our 5 plus our 300 minus our 27. Notice the adjusted book and the adjusted bank balance are the same. So hopefully this got you thinking. Here, your critical piece is to know the adjusted bank balance and to know that the adjusted book balance is also the same. They cannot be different. So let's go through how much cash. I always like to read. Let's go through another illustration or another example. And I'm going to start with the question here of how much cash does Logan actually have? So here we have an ice skating rink and we received our monthly bank statement and it shows our balance. So this $1,500 is our bank balance, right? And then on the bank statement, and in our bank collection of accounts receivable of $818. So we're adding that to our books because it's on the bank side, and it also shows a service charge of $14. So we also want to make sure we deduct that on our book side. We have 2 NSF checks, which both total $240. Again, that is going to be on our book side. And we have $20 charge for printed checks. So all of these, so this amount is added, but these amounts, we have service charge, NSF, and our $20 charge. Those are all less our book balance. And we're going to go through with this. Now, when we review our cash records, we identify outstanding checks of $12.20, which we know we're going to subtract from the bank side. And we have a deposit in transit, which we know we're going to add on the bank side. And during July, we had a $540 check for a salary of a part-time employee as $54. So we're going to have to take that $540 and we're going to have to subtract that $54, and that will give us $486. And that is a difference that's going to go on our book side. And then our cash account, which is our bank, this is our book balance, shows $3,752. So keep this close so we can go through the process. So first and foremost is we take our $1,500, which was basically our bank statement balance. And then so we show a cash balance of $3,752, which we will note here. Now we have on the bank statement, we have a collection of accounts receivable of $818. So when we do that, we're going to see that right on here, so that we know is on the book side. And then we have a service charge of $14, so we're going to show that as reduction in our book side. Then we have NSF checks that we're going to reduce from our book side, and $20 charge for our printed checks is also going to be a reduction on our book side. Then once we look at this, we have a July deposit in transit, which we're going to add to our bank, and our outstanding checks we are going to subtract from our bank balance. Then we have to record the actual error in our check. So here, if we see, we have 540 minus 54 gives us the 486, and we basically need to reduce that because it is an expense, right? It's a salary expense. And so then once we do that, then how much money do we truly have? Then we know that both of these should equal, so the answer to this question is 3810. So this concludes our lecture on chapter 3. Now please answer the questions on the side here, as these are some of your sample test questions that you will see possibly in your upcoming exam.